If I told you the biggest mistake investors make are the ones they don't even notice, would you believe me? Because the truth is, most investors don't fail because of bad stock picks. They fail because of bad habits. And the scary thing is, these habits feel logical until they quietly drain your wealth over time. Even the most successful investors like Charlie Munger, Warren Buffett, and Peter Lynch, they didn't get rich by following the crowd. They got rich because they mastered a set of timeless principles that most investors ignore. Today, I'll give you the same principles. And by the end of this video, you will know exactly how to think, act, and invest like the top 1% of investors. Let's get into it. Mistake number one, the illusion of market timing. You've heard it before. Buy low, sell high. Sounds simple, right? Well, here's the catch. No one actually knows when the market is at the lowest or highest point, not even the so called experts. Study after study has shown that investors who try to time the market have underperformed those who simply stayed invested. Why? Because the market movements are driven by millions of unpredictable events: economic reports, interest rates, human emotions, and political events. Here's a classic example. If you had invested $10,000 in the year 2000 and you missed just the best 10 days, your returns would have been cut in half. That's just how costly it is to time the market. And most people fail to understand this. For some reason, they think they can beat the market, they think they can time the market, and people who have tried this, they've failed woefully. Instead of timing the market, use dollar cost averaging, DCA. Dollar cost averaging means you are investing the same amount weekly, bi weekly, monthly. You can set whatever period of time you want, whatever frequency you want. You just have to invest the same amount. What this ensures is that you are buying more when the market is low, and you are buying less when the market is high. But over time, your cost averages to something that's more favorable to you. And this is how you beat people who try to time the market. Legendary investor Warren Buffett said, the stock market is designed to transfer money from the active to the patient. So the key here is, do not try to time the market. Be patient and let the market work for you. Mistake number two, overreacting to short-term news. The news cycle is built to keep you anxious. Every day there's a news that makes people panic. And you panicking leads to making bad decisions with your investment. Let's take a look at history. The Great Depression, the 2008 financial crisis, the COVID crash. Investors who stayed invested made massive returns once the market rebounded. And those who panic sold, they locked in losses that were not even real to begin with. Stop checking your portfolio every single day. Set a schedule and just check it once a quarter. That should be enough. If you're looking at daily stock movements, you are no longer an investor, you are a gambler. The best investors trust your strategy and they let time do the work. Here's a powerful quote to remember from Benjamin Graham. In the short term, the stock market is a voting machine, but in the long term, the stock market is a weighing machine. Mistake number three, failing to think in decades, not months. The single most powerful force in investing is time. Yet most investors fall for short-term wins and not long-term wealth creation. Interesting fact, Warren Buffett made over 95% of his wealth after the age of 50. Why? Because he let the power of compounding do the work for him. He wasn't buying and selling stocks every single month. So here's something that you have to understand. When it comes to your investing, just like Warren Buffett, who made hundreds of millions of dollars after the age of 50, you have to think from a long-term standpoint. You have to think in decades, not months. Here's a powerful tip that I use. Before I invest in anything, I ask myself, would I be comfortable holding this for at least 5 years? If the answer is no, then I'm just gambling. I'm just speculating. So you want to make sure you stay in it for the long term because that's how you win. Mistake number four, chasing what's hot. Most people don't pick stocks. They chase them. They see a company go up 200% and suddenly they want in. That's how bubbles form and that's how people lose a lot of money. chasing trends, chasing hypes, chasing the next hot stuff, the shiny object syndrome. You don't know anything about the company. Just because it's going up, now all of a sudden you want to purchase that stock. This will get you wiped out financially when it comes to investing. The best investments aren't the ones making headlines today. The best investments are the ones with strong fundamentals that no one is talking about yet. Peter Lynch, one of the greatest fund managers ever, said it best. If you invest in a company simply because it's doing well today, by the time you invest, it's probably too late. Before investing in any hot stock, ask yourself this: would I still want this stock if no one was talking about it? Remember, the market is filled with people who know the price of everything and the value of nothing. This is the quote that I love from the famous investor, Philip Fisher. Mistake number 5, ignoring the cost of fees and taxes. You might think you're making money, but if you're constantly buying and selling stocks, you, my friend, are getting hammered thousands of dollars when it comes to fees and taxes. So you got to pay close attention to this one. You cannot ignore your fees and taxes when it comes to investing. Each time you buy or you trade a stock, you buy and sell a stock, you have some fees associated with that transaction. And taxes if you had a gain. So you don't want to ignore this, especially if you're holding anything longer than 12 months. If you're not holding for longer than 12 months, the long term, you're going to pay more capital gains taxes. So you got to pay close attention to the impact of taxes and fees in every transaction or every trade you make when it comes to your investments. Let's do the math. If you invested $100,000 at a 1% fee charge over 30 years, by the end of the 30 years, you would have paid about $200,000 in fees alone. Yes, you heard that right, $200,000 in fees. This is much more than your original investment. This is what you get for ignoring fees. So most times people don't pay attention to this. They think, oh yes, I've got a long-term investment. I'm not chasing the next hot stuff, and I'm just going to be patient for the next 30 years. And guess what? By the time they get the bill for ignoring the fees, they will be surprised and shocked. So what can you do today on your end to minimize this? Use low-cost index funds and avoid unnecessary trades. Remember, value is what you get and price is what you pay. At the end of the day, wealth is not built on the latest stock tip or the next market hype or the latest trend or wave in the market currently. It is built on a set of principles. And if you can avoid these 5 mistakes, you will be way ahead of 90% of investors today. Here's what you must remember on how to win the game of investing. 1, stop trying to time the market. Use dollar cost averaging. 2, ignore the noise. Think long term. 3, use the 5-year rule. Don't gamble, invest. If you can't hold it for 5 years, don't buy it. 4, don't chase hypes. Focus on fundamentals. 5, minimize taxes and fees. Invest in low-cost index funds and avoid unnecessary trades. If this video helped you, hit the like button and subscribe for more. And if you are serious about investing, if you want to learn, if you want to take this a step further, you want to learn more of what I've done and what I'm doing currently in my investment journey, I've put together an in-depth framework that I use to avoid timing the market. I call this the 3-step anti-timing framework. This is how I combat market timing. Click the link below and download this for free. This is at no cost to you. Thank you for watching and see you on the next one.